to get started. I'm going to mute everybody and feel free to include any questions that you have in the chat box, and we'll go from there. And as I go, as questions come up, feel free, send them, and we'll try to get everything addressed and hope everyone gets some great value out of tonight. And thank you all for attending. Let me switch. I'm going to go to a screen share, and so tonight wanted to cover real estate investor tax issues. And again, thank you everyone for joining me. A little bit about myself. I'm a real estate investor and money lender, and more importantly, tax reduction strategist. I like to call myself licensed CPA for 20 years. I've worked in public accounting, spent some time in industry as a CFO of a large national electrical contractor. So pretty much been on both sides of the table, and able to really work with my clients. And so I think those of you that know me, others that don't, I'll be more than happy to discuss things further, but don't want to bore you with everything about me. So I'm going to move on. Here's a quick disclaimer. Everything presented tonight's more of the general nature. Please don't sue me. If something comes up tonight that's been presented, it was more of a general nature, and down the road, if a transaction comes up, I always advise clients to consult with me, and we can go from there, because a situation we discussed tonight may sound like it may apply to you, but I wouldn't use it as tax advice or tax opinion. Real estate's risky by nature. Those of you that are already in it, I think, know that. Win, lose, or break even. But until we have a professional relationship, everything is general tonight. So there's my legalese and my disclaimer. Appreciate everyone for joining. So some of the topics I wanted to cover tonight were tax deductions and good bookkeeping best practices for new investors, taxability of investment real estate owned personally versus through an LLC or an S corporation, 1031 exchanges historically have been a great tool for wealth creation and preservation, and then some of the possible changes with the tax law and the new administration in 2021 and beyond, and where I see things happening based on experience and some of the proposals that are out there right now. But first, one of the questions I get from a lot of investors is they're an investor. And those of you that know me and have talked with me, I really try to dive into what you're doing, because I think those of us that think we're investors, you might be a house flipper really in this area. What I like to call your active and ordinary income. We also have investors that are more of just the buy and hold landlords. They'll buy a rental property, put a tenant in it, and just collect rent. It's fantastic. Then there's also what I really call more of that investor portfolio slash speculator type investor that, let's say, is going to buy a vacant piece of property, hoping that the neighborhood is going to go at a future date. And the biggest thing is I always run into is real estate. It could be a home, a flip, a rental, speculative, because we're going to level the property. It's really all sticks and bricks and dirt, but where it comes on your tax return is really the biggest thing. And my job is really to work with my clients and those of you to be able to try to figure out which of these buckets it's going to go into. Those of you that are flippers or just buying houses, building houses, more on the construction side, are really going to fall into this category. Wholesalers that are on the call tonight. And that's really where the biggest question is. Problem with that, you're really running into more of the higher tax rates and then also the self-employment tax. And then I always like to say, think of that your real estate as an inventoried asset, just like the clothing store shirts on the rack. That's what that real estate is. You might be adding value to it by improving it or renovating it. The biggest question is with active activities such as a flip activity, it's going to be something that a 1031 exchange is not available to you because it's really just ordinary income. You're not going to depreciate the property. You're going to acquire that property and then add value to it, such as the improvements, your additional cost. That's going to be your cost. And then you're going to sell it maybe in the retail market to another investor somewhere. You're going to end up selling that property. And the biggest question is you start a property in September of 2020, incur a substantial amount of costs, and then sell it in January 2021. Where do all those numbers fall? Your costs are really carried into the next year generally as an inventory of that activity, and then you're going to use that against your sales price. So let's say you buy the property for $100,000, you put 50 in renovations, and you sell it today for 200. Your deduction just on that transaction is really none for 2020, and then 150 this year, with 200 for your sales price less your 100 of purchase and your 50 of improvement. So the big thing there, that $50,000 gain would be subject to self-employment tax and also income tax. Depending on other factors, you're going to be somewhere in these tax rates. So proper planning, sometimes we can minimize or reduce those. And in that case, from an active ordinary person, your losses on the deal are not limited. So that same deal, let's say you put 150 into it and something happens in the market and you sell that property and for 100,000, you've lost 50,000. You're going to be able to take that $50,000 loss against other income. For those of you that maybe one spouse is working and the other is a full-time real estate person, those losses are great to offset your W-2 income. So really opens the opportunity. Those losses, though, could also offset your W-2 income from your management company. So as your investment portfolio and activities really start to get more complicated, how you structure things can have advantages. So more on the buy and hold. I think those of you that are familiar with rentals, this is on the rental side, real traditional Schedule E. On the entity return, those of you that are familiar, then the biggest thing is passive income and also passive losses. So for those of you that you're a W-2 investor, working a regular job, you might have a good W-2 job, you buy a few rental properties, and it's generating some losses from your improvements to that property or your depreciation. Hopefully it's positively cash flowing, but you're going to end up with losses. The biggest thing is your rental income and loss is going to be ordinary, but you're going to be subject to limitations on that. And we'll get into that further. Quite often I get questions on real estate professional status that can be utilized. But on the rental income loss side, so for instance, let's just say the husband's a full-time real estate landlord. You're generating $30,000 in losses on your rental activities. His wife makes $75,000, and in that case, they would be able to deduct 25,000 of their losses because they're not limited. If they make over 100,000, those passive losses become limited, and if they make in excess of 150, those losses are zero that they get to deduct. So let's say the husband is losing every year 35,000 on his 25 property rental portfolio because of depreciation and other deductions. and the wife makes 175,000 a year on a W-2. They're going to get their deductions, but it's going to be what's called a passive loss carry forward. That's really going to come into play because in their case, the question how aggressive they go with depreciation or some of their improvements is somewhat of an irrelevant point, because they have activities that, yes, we can make that loss greater, but they're not going to get a benefit. Those of you that find yourself in this situation, you're not going to lose those losses. You just don't get them today. When you sell a property, though, if you haven't aggressively depreciated it, your basis will be higher. In theory, your gain will be lower because you've depreciated it. And then when you do sell that activity, let's say next year, that same investor with the $35,000 passive loss carry forward sells a property at a $75,000 gain, that will free up those passive losses. So that's more what I call that W-2 landlord that, you know, has some rental properties, is making a substantial W-2, wanting to get into investment, and really looking at planning for those. When they sell properties to them, they could do a 1031, but they may not need to. They might want the gain on the sale to utilize some of their passive losses. So it's really with proper planning, you can minimize your taxable income if I know the facts. I like to work with clients more throughout the year if they have a property that they're looking to buy or sell. I actually had a call with a client today. They're closing on a property they're selling next week. They contacted me and at least able to walk through the transaction and some of the nuances there. There's more that we can do before you get to the closing table, whether you're buying or selling. Then there's a little less I can do after you've already sold it, but we're still in the year. If you call me in January 2021, there's not much I can do for 2020. So I like to have more of a proactive relationship with clients. And really, I think every investor really needs to, especially as things get more complicated, because as your business develops, you're also going to run into a situation once you start dealing with lenders. And yes, paying minimal tax is great, but having lower taxable income is tougher to get lending on until you have a great substantial rental portfolio. You can borrow on the asset. But if you're an active flipper and not making a decent living, it's tough to get funding when you flipped 10 houses last year and your records are showing that you only made $15,000. And when you have hard assets such as real estate, if you owned 20 properties, made $15,000, $20,000, you could probably still get a mortgage. And there's other opportunities as you grow. But that buy and hold investor, you have 1031s available, depreciation. Costs are going to be deductible when placed in service. And again, think of yourself just as that traditional landlord. Then I also get into the investor / portfolio. Think of Google stock. You're going buying a stock, waiting for it to appreciate. No different than buying a vacant parcel of land on a busy intersection. You're waiting for the day that I own it for 5 years and Starbucks is going to knock on my door and buy that property from me. And I paid $500,000 and they're going to offer me 1.2 million or whatever it may be. I think those numbers are a little bigger, but at least so everyone can conceptualize this. I spoke with someone else today that was buying a vacant piece of property in Detroit. It was at a nominal cost, but really their intent is to buy that property, own it for maybe 4 to 5 years, depending on the neighborhood, potentially develop it into a home, a strip mall, or just sell it at a profit. If I own it through my active flipping company, that's really an inventoried land, and I'd really hate to buy that property for $50,000, sell it for $150,000, make $100,000 on my investment, yes, I get to deduct my insurance and my property taxes, but I'm going to pay self-employment tax and ordinary income tax. That same activity, this is where using different entities to hold your real estate can make a difference, because the one thing to keep in mind, everything in the IRS says the taxpayer is me, Frank, but it could be myself, my investment LLC, my flip LLC, my buy and hold real LLC. Um, I'm not one for overcomplicating things with too many LLCs, but this example of just buying some dirt that you're going to speculate is a perfect example. I would want to probably separate this activity in its own LLC and really hold it for long-term investment. My carrying costs, such as property taxes and insurance, are going to be something that's an investment expense, not deductible because of the current limitations on Schedule A, no different than portfolio deductions on your margin account that you may have with a broker. 1031 is not going to be available in that transaction, but you're going to have the biggest thing is you're going to be subject to capital gains, which is 0 to 20% based on current tax rates right now. If you lose on that deal, your losses are limited to 3,000. So if I lose 50,000 on this property, or let's say 30,000, it's going to take me 10 years to extinguish those losses because they're investment. This same activity, I could write that 30,000 off this year. So a lot of times my best answer to a client's question is it depends, because I always ask, what's your intent? What are you going to do? Are you a home builder that's buying some dirt to build some houses on and sell? It might be some planning where we can really capture the capital gains and the ordinary income. If you're buying the dirt today, you don't expect much appreciation, and then you're going to sell the houses. You're probably going to fall into ordinary income. If you're buying dirt and you're going to build a rental property, might be a large situation such as large commercial, a strip mall. It might be a situation that no might be a situation that you're going to buy some dirt and I'm going to build a storage facility on there in maybe 2 years from now. As my rental activity, that dirt that I buy for 50,000, but when I put my actually begin construction is worth 100,000, my basis will be 50,000. But if investment LLC sells to storage rental LLC for 100,000, I might, between the two LLCs, recognize $50,000 capital gain, and based on current rates, might pay a minimal tax gain. But then now my storage facility is going to have an increase in basis, and it really needs to be a brother sister type transaction, that entity A and entity B are not a entity A owns entity B. It needs to be two separate companies. The new operating company could be one that I have partners in, but me personally, Frank, would have to recognize gain at the time that I do that. So depending on the numbers, it's not for everybody, but it's definitely an opportunity. And then in the meantime, that piece of dirt that you're carrying, maybe you put a cell tower, let somebody put a cell tower and a billboard on it to pay some of your property taxes. That's really going to be more de minimis rent. So I'm kind of tried to lay down some definitions, I guess, to keep on the focus tonight, because which bucket your activity is going to fall into is really the biggest thing for any investor, whether you're a wholesaler looking to get started, you're looking to flip some properties. You might be someone flipping properties to fund your longer term rental business. And then those of you really like to bring up the fact about passive, because those of you that are active, may have a different situation than when you're reaching out to that doctor friend to invest and telling them about the losses that they're going to benefit from. But the doctor makes $400,000 a year and you're going to syndicate a deal and he's going to get 50,000 or 100,000 in losses. Generally, he's going to be limited, so they're not valuable to him today. They might be valuable to him as a longer term investment play, but really understanding as you start to work with partners and other investors what the deal entails. So, and also how it's going to impact your return. And really, if we can, for those of you with passive income or passive losses, utilize those to reduce some of your ordinary income, be it your active flip and current buy and sells that you're doing, or other W-2 that you have if you're a current W-2 investor. Any questions or anything on that?
You have tons.
Okay. One about the slides, I will be sending, I can send those out. Again, they're just for informational. Don't base any of your decisions or investment decisions on them. And I'm not saying on the nature of something being a good or bad investment. Then record keep on the house is dirt. Okay, so here's a question. Someone bought a house, bought some houses dirt cheap and holding and really sitting on them, waiting for future rehab or income coming in. So right there is a perfect situation. If they're just sitting there, boarded up, vacant, you're paying the property taxes, cutting the grass because you have to cut the grass, but you're doing nothing with them. That would be a perfect situation that I would say you might put that in new investment LLC and really have that maintain that as an investment, because maybe the area turns around and your intent is to sell those. If you're going to tell me that you're holding those because you're going to flip them and put 50,000 into them and that neighborhood's going to turn around and those houses are going to sell for 400,000, those separate entities might help, because if you're the guy that's also doing 10 flips a year, all in your personal name, as I quoted earlier, taxpayer is really defined loosely, or but it's the person. So if Frank is flipping 10 houses this year, but also owns some dumpy houses that he bought dirt cheap, who's to say these weren't just flips in ordinary income? That's why I personally would set these in separate LLCs. So my active LLC at a future date might buy these at a capital gains transaction from my investment LLC, but I still have flexibility. Yes, it's a little bit more complicated on books and records, and I tend not to advise clients to complicate things too much from that standpoint, but I'd rather at least discuss 5 options that you'd have, and you can decide, no, you only want 3 of them. Otherwise, I'd rather advise a client to have 5 options and maybe never need them, but when you need them, it's tough to unwind what happened in time. So might be something to look at, really depending on the number. If we're talking a $5,000 house that you think might go up to 10,000, it's a great return on investment depending on the time, but it may not be as much exposure for the additional record keeping. If we're talking a $500,000 property on $1 million sale, it's definitely worth the additional record keeping if we can minimize that tax. So let me look. So one question is, the amount of rental passive income make a person lendable, generally speaking? So really, a person being lendable is gonna, if someone's got a W-2 and has some passive rentals, for one, they're gonna look at the properties that, if you're getting a mortgage, then your W-2. If you're just a full-time investor and trying to get rentals, that's a different area, and I would advise really an investor-friendly mortgage company. I'm not a mortgage broker, so can't really speak. And I've seen deals go through that I thought the person was never lendable, and I've seen ones that I thought the person could get money all day long and had a hard time getting it because of one reason or another. So again, really establishing those relationships with that lender on the front end. And also, I always stress having that good, solid tax return. A lot of times I get questions, what's the best refund you can get me? I don't know. I'm going to get you the right refund. I see tax returns quite often that I never could get the refund that they got because it's just flat out wrong. And I've not been able to do those. Other ones, if everything looks right, I usually, unless I see something wrong, there's circumstances that I might look at your return from last year, but you've been an investor for 10 years. It's hard for me to really say it was right or wrong at the time because of the facts and circumstances 10 years ago. You made certain decisions when you had a very strong or a very weak W-2, as you can see, impact different things. Or it may be just you didn't have the right advisor, but we could speak further on that, but really, I think having a strong, solid tax return that makes sense makes you lendable. If you're dealing with a private lender, for instance, if somebody can't put together a deal and tell me what their profit's going to be and show me some history on deals they've done, I may not be interested. Again, real estate's deal by deal, and who's going to have control? Do you want my money and you're going to have control, or are we going to be partners on it? Anything can be worked out in real estate. So in that case, you might be lendable if you give up control or a profit split. Anything can be done. And I think those of you on this call have seen some creative things that you probably never saw before you got into real estate. So
I would like to add something.
yes.
I have a bookkeeping client he is not currently a real estate investor, but he wants to be. And I've been helping him for a couple of years with his books, and he has never filed taxes. And I would advise anybody doing anything really, and this man is a grown man. He has never filed taxes. He is not living in the gutter, let's say, and he wants to borrow money from the bank, from the neighbor, from whoever. If there's anybody on here, and I'm thinking there's probably not anybody on this call that's not filing taxes, but just do it even if you're not making any money. Some people think that if they don't have to pay taxes because they didn't earn enough to pay taxes, that they don't have to file. You have to file, no matter if you made money or not. Right, Frank?
Yes.
I'm just, this could be your brother-in-law that isn't paying his taxes or doing his taxes, but just anybody listening.
Or I think sometimes in certain trades or whatever, you've got the guy that works for cash and will only pour your cement with cash and he'll be there tomorrow. But yes, he can make money, but nobody's
That's
ever
good
going to
until you want to buy something real.
Yes.
So, okay, that's enough.
So one question I see comes in as far as rentals, not having any losses, then having offsetting income. So if the rentals don't have any losses, you'll just have additional income, which is going to be taxed at, as I said, on the buy and hold at the ordinary rates, not subject to self-employment. But then in the same situation, dealers versus capital gains. And I think the question was kind of alluding to what really comes into play. Think of the the Pulte homes that come in, they buy a piece of land, build a bunch of houses. They're really treated what's called a dealer. and they're falling into what's called ordinary income. They're probably not doing a Schedule C. They're a public company. It's on page 1 of their tax return, but it's going to be taxed at ordinary rates. That question, then, the standard capital gains, the IRS is going to look at number of transactions. Are you that investor? And that's the perfect scenario that they're going to have the investor structure for that speculative land. Most home builders and developers that I deal with usually have an investment entity, a development entity that'll go in if they're a developer that develops the roads and neighborhoods and the sewers and does that. And then they'll effectively have the company that you and I are going to buy the homes from. But what they're doing is they come in, they'll buy through investment company, they'll buy for land on the outskirts that they're going to build on in 5 or 10 years. They're buying up that raw land for that investment. As it appreciates and they're getting ready to break dirt on it, there may be a transaction that they recognize that, let's say, home builder investment company sells to home builder that's going to be building. There's a transaction at this time that could be done to recognize capital gains, effectively locking in that lower tax rate. Let's say the property was bought for 100,000, appreciated to 200 and sold to this company. That's where then now the development that's building the homes has basis of 200 in that land, and really increased it by selling it from that brother sister scenario. This company is going to sell to this company, and they might be owned by a holding company. Then you run in, and that's where separate entities, this LLC's operating agreement would probably read something that investment or company is set up for the purpose of long-term investment in real estate, make no statement of developing or selling homes. This company here's operating agreement would probably limit them from buying any investment properties. It's really facts and circumstances. I think the $3,000 lot that you buy in Detroit that you hope turns into a retail area that you sell for 30 grand, your risk and exposure is going to be different than that $1 million parcel of land that you're hoping you can sell for $5 million to be an office building somewhere. So it's always facts and circumstances. I wouldn't say beat it to death if we're talking $3,000 pieces of property, but as they grow, and at least my point here tonight is really to be able to give everybody the tools to know when to ask the right questions, and hope that helps. And then I think I covered everything. Then keep it.
I put one more in there. Tom Hutt had a good question.
That was kind of what I was covering as far as the investor versus dealer situation. So, okay. So, so I'm going to kind of move